Bob, the mood in Davos so far, you'd have to say, reflects the debate in the outside world. On the one hand, you have bankers being bashed. On the other hand, you have bankers rising to their own defense. Are you surprised that that so quickly has dominated the tone here at the World Economic Forum?
Well, I think, we have both a responsibility and an obligation to be a part of the debate on financial regulatory reform and working with legislators, working with regulators, working with other banks. We all have the same goal, Eric, and that's a safe and sound financial system, a financial system that can lead to job creation and economic growth. And I think Davos is a good environment to add some balance to those discussions.
Everybody wants a safe and sound financial system. Is populism, though, the way to get there? Just last week, Tim Geithner said, just because it's populist doesn't necessarily mean that it's wrong.
These are the right questions, and I think we have a framework for discussion and a framework for regulation, and it's the G20. And it's bringing an opportunity for many countries working together, many regulators working together, to come up with constructive solutions for just the things we talked about, safe and sound, job creation, and economic growth. I think the difficulty is when elections are concerned or politics are concerned, they tend to be very national in their underpinnings, by definition. And I think the financial markets, but more importantly, our clients and our customers are global in their activities. And so I think the G20 framework has been quite effective around compensation and the guidelines for that. And it's got traction around capital and liquidity and leverage. And our preference would be to see this work not in isolation in separate countries, but through the G20 framework.
But to your point, politics begins to play a role. Can you reasonably expect the G20 to retake control of this situation after what we've seen thus far in Britain and from the President in the United States?
That's certainly our expectation. That's certainly our hope. We think the G20 framework is strong, and we're continuing to work constructively in that framework. So, that's going to bring the right solutions. And I think the unintended consequences of a separate national approach is that we get in a situation again with an unlevel playing field. And we saw what happened when AIG was able to have derivatives in a subsidiary that wasn't regulated. We saw what happened when Fannie Mae and Freddie Mac were allowed to build massive risk portfolios. These were institutions whose original charter was to provide standardized mortgages at reasonable cost to middle-class Americans. And so we need a capital regime that is effective but also doesn't provide regulatory loopholes.
If the G20 is ultimately going to give us the right approach, as you say, what if that approach includes taxes on bonuses? What if that approach includes taxes on the 50 largest financial institutions in the United States? What if that approach includes measures like those advocated by Paul Volcker against proprietary trading and too big to fail?
Well, Eric, let's take those in order. We came out very early, in fact immediately, in support of the G20 principles on compensation. The G20 principles, the Financial Stability Board, and the FSA, and we supported those immediately. Around capital, we also think that an opportunity to work through the G20 in terms, and we're already working in a number of subgroups around the aggregate impact of all of the capital measures on the cost of credit and the potential impact of that on the economy. We're working on ways that we can work together with the regulators and the legislatures around the financing markets and bringing securitization back. So I think we've seen good progress in this regard.
But the debate appears to have moved beyond what the G20 was talking about. I mean, you know as well as I that taxes on bonuses were not part of the G20 discussion. Taxes on financial institutions were not part of the G20 discussion, both of which have serious implications for your firm.
Well, we talked about compensation. Listen, banks recognize that they played a role in the crisis. They certainly weren't alone, but banks played a role. Many of the banks that took direct money, and we were pleased at Barclays that we never took any direct money, but we recognize that we're beneficiaries of the fiscal and monetary stimulus, as were governments, as were central banks, as were pension funds, as were hedge funds. We all benefited, and it was a recovery we all feel good about today. I think all banks recognize also that smaller banks in the U.S., 140 small banks in the U.S. have failed in the last year with no cost to the taxpayer. because the money came from a fund, FDIC, that was contributed by banks. So the concept of banks recognizing their obligation and thinking through how they can contribute, whether you call it a tax or an insurance scheme, I think we all are willing to be constructive. I don't think it works if it's done nationally. I don't think it's constructive if each country has an isolated approach, but through the G20 process, I think the banks are very constructive in this regard.
Is that to say that Barclays, being an institution that didn't require government assistance, feels okay paying into programs that are a direct result of that government assistance?
There's two aspects to the government assistance. I think in terms of the TARP money, as an example, the vast majority of that has been paid back by the banks. I think what many of the regulators are referring to is, going forward, can we build a fund that makes us more comfortable that if there are failures, that much like we did with the FDIC for the smaller banks in the U.S., we have a resolution fund for larger banks and cross-border banks.
That's what people like...
That would best be done, Eric, through the G20.
Okay, I take your point. That's what regulators like Sheila Bair are talking about. But that's no longer what the President and Paul Volcker are talking about.
Well, I think I was quite clear. I think it's better for the financial system if we work in a coordinated fashion across border. There's a tendency, Eric, on too big to fail that big is bad, and that large banks are inherently more risky or more dangerous. There's no evidence to suggest that. There's no academic papers to suggest that the well-managed banks that are well-regulated can't provide a resolution plan in times of crisis. But more importantly, banks aren't big just because they want to be big. Banks are large and banks are sophisticated because our customers and clients in our financial markets are big and they're global. And particularly in the post-communist world with so many free trade initiatives, banks grew in their ability to work with corporates and with pension funds in transferring risk across border. And it's been very positive in terms of economic developments around the world. It's been very positive for the large pension funds around the world. It's been very positive for our large corporate clients around the world. So the unintended consequence is a negative impact on the economy and a negative impact on jobs. So we should be quite thoughtful before we jump to the conclusion that big is bad.
Do banks need to do a better job of closing ranks, of speaking with one voice on these issues?
You know, I'm not sure what the answer to that is. The banks compete with one another, 365 days a year. One of the things that's terrific about Davos, and something I've appreciated over the years, is in the Finance Governors Forum, which begins tomorrow and runs for a full day. I get to spend time with other senior people at other financial institutions, banks, insurance companies, and discuss issues just like we're talking about today. And so it is constructive. But we also have an opportunity to spend time in forums like that with regulators and lawmakers.
Are you surprised that some banks are talking about moving some of their operations out of these, call it pro-tax jurisdictions, into others that have a much easier approach, let's say, to taxes, such as Switzerland? You hear people talking about moving commodity traders to Geneva or to Zug, where there's an established commodity trading presence in both cities.
I frankly don't think any bank is thinking about moving operations around taxes right now. I think if in our view, the world is a better place, the financial markets are stronger, if we have a strong financial center in London and a strong financial center in New York. We want a level playing field around the major economies in the world, and that's what the G20 should be working toward. I think for any bank like Barclays, having a concentration of our risk-taking is much better from a governance and control and from a capturing the synergy point of view. So we would very much like to continue to have the base of our operations in the two big financial centers in these two time zones, obviously as well as in Asia. So our view is that the financial markets need a strong London and the financial centers need a strong New York.
Notwithstanding the fact that others may not feel quite the same way.
Others may not feel the same way.
Let's talk for a moment about market conditions. We've seen some volatility return to the market as of late. And at least in equities, the VIX suggests that we're going to see sustained volatility for the next several months to come. Is your expectation similar?
Yeah, I mean, if I backed up a little bit on that question and how are we feeling about the economy, we're actually feeling pretty positive, particularly in the U.S. We've been positive, Eric, as you and I have talked about Asia for quite a while. We saw growth come back in the U.S. this summer. Right now, if you look at the impact of the incredible monetary stimulus, the fiscal stimulus, the weak currency, the weak dollar, the collapse of so many of the cyclical industries such as autos, the impact on employment and labor, then we actually see a pretty positive story going forward. The possibility for job creation between now and I would say the middle of this year we feel pretty good about, and we think we'll see a materially better picture on spending and jobs by the end of this year.
So a better picture economically for the developed world, but it's not translating at the moment into market confidence. We saw a lot of market confidence over the past 6 to 8 months, but all of a sudden it seems to be faltering.
I think that's absolutely correct. I think one of the things that has changed just in the last couple of weeks is that all measures of volatility have increased significantly, and there's a lot more uncertainty. And I think when we're in a situation where there are different proposals being driven by different countries, as opposed to the coordinated, integrated approach, I do believe, quite frankly, that will add to volatility.
How does it change your strategy if the United States, just to cite an example, were to go ahead with something akin to what the President has proposed, both on the risk limitation front and the taxation front? Would you consider steering resources away from the United States and to other markets where you see healthy growth prospects?
Well, a lot of the measures that were discussed around not being an owner of hedge funds, not being an owner of private equity funds, and not being engaged in separate proprietary trading, frankly, have very little impact on us as Barclays. We exited the separate proprietary trading businesses in 1998. It was a strategic decision to put our capital closer to our client flow businesses, and it's been successful. I would go back to my earlier point, which I'm not sure this is the right way to draft these types of measures. I'd much rather see a focus, rather than on rules, on the overall capital allocation to banks and make that consistent. You know, banks do get it. Banks have recognized for a while that we're going to operate with more capital, with better quality capital, with less leverage, with bigger pools of liquidity. No one's saying that we haven't made mistakes in the past and we're not willing to, focus on helping make the financial center more safe and more sound. But we're also saying that we should do it in a measured, thoughtful way, and it's critically important to keep a level playing field between the major financial institutions. Eric, I don't think we have a single corporate client in the U.S. that doesn't manufacture in multiple locations around the world, that doesn't have risk exposures in multiple locations around the world, doesn't have shareholders in multiple locations around the world. The fact that we have an isolated financial system in the U.S. is just wrong. And I'm not sure there's any country in the world that's benefited more from free trade, global trade, and cross-border trade than the United States of America.
If you had to distinguish between proprietary trading and market making, would you even know where to draw the line?
I think in an extreme case, we probably all know the difference between a separate proprietary trading group or a hedge fund and market making. I think we're all scratching our heads a bit on what the intention of the announcement was. And I think it's really important because, if banks aren't taking risk, then banks aren't doing their role and doing their job in terms of helping the economy improve and helping job creation. I've talked often about the example of trading in U.S. Treasury securities. The outstanding debt of the U.S. in treasuries, bills, bonds, and notes, as well as agencies, is almost $8 trillion. I mean, it's a number that it's hard to even imagine, $8 trillion. And over half of that comes due in the next 18 months, the next year and a half. So for firms like Barclays Capital, who help issue that debt and help sell it around the world, we have to constantly be making market and making prices around the clock. That's in pursuit of a client-driven business, but it also takes risk allocation and takes capital. And I think it's important to separate that type of activity from what's being talked about on the other side.
A lot of people say the specific mention of proprietary trading was targeted at Goldman Sachs. Goldman Sachs fires back consistently and says proprietary trading doesn't make up more than 10% of our revenue and 10% of our earnings. What are the figures at Barclays Capital?
I think what we've said publicly is, depending on how you define it, it's something around 1 to 3% of our revenues in Barclays Capital, so less as a percentage of the group. Could be defined as proprietary, but I think we're also wondering exactly how that definition will come out. So it's not a substantial part of our operation. As I said, we had made a decision over 10 years ago to exit our separate proprietary trading businesses.
What would happen, presumably, Paul Volcker's intent here is to eliminate risk. That's what the president has said he wants to do.
I hope not.
Well, risk in the financial system.
I hope not.
If, in fact, they do go ahead and ban banks, deposit-taking institutions, from investing in private equity transactions and private equity funds that invest in such transactions, is it not possible that they could also ban the very same banks from financing private equity transactions? Because, as we've seen, there's risk there too.
Well, Eric, anything is possible, and I don't think what Mr. Volcker is proposing is that banks don't take risk. And I think we're all working to make the system safer and sounder. So I think we're all starting out in the same position. And I know I'm a bit repetitive, and I apologize, but I'll go back to what I said earlier. The right way to approach this would be to be working with the UK, with France, with Germany, with the other major economies in major countries, and come up with a capital regime and a liquidity regime and a leverage regime that's consistent and constructive. And I think the banks are willing to work toward that. If I look at Barclays, and I don't mean we're different than many of the other big and successful banks, but since this crisis began, our core equity capital is almost doubled, from below 5% to over 9%. Our leverage, which was over 30 times pre-crisis, is down closer to 20 times. The amount of liquidity we hold every single day in case of a crisis is 3 or 4 times larger than it was. So the banks get it, and the banks did have to make changes, and I think the banks have constructively been making changes. And I think the more we can get away from political rhetoric and look at the facts, and the more we can move from isolated national initiatives to coordinated, integrated initiatives, I think we're going to come out with a better solution, and I think it's going to be more supportive of job creation and economic growth.
Let's say things don't move to the G20 platform and we're stuck with the worst case scenario. That is, from the shareholder standpoint, from the bank standpoint. Have you quantified the worst case scenario? Have you even considered what it might ultimately cost your shareholders?
I think what people miss in this is that business is going on. For 2009, we've talked about this. Particularly with the benefit of the Lehman acquisition, we did more business with more clients in more countries, in more products than in the couple 100-year history of Barclays. So business is going on, and I think there is the prospect, as I said, for constructive engagement here.
And provided it's done on a level playing field, everybody's subject to it equally.
Very important, yes.
All right, Bob, thank you very much. It's always a pleasure talking to you.
Thanks, Erik.